weekly S&P 500 chart. We're going to show that one here, and we're also going to show this S&P 500 monthly chart here as well. So basically, when we take a look at the shorter term view, what we have here, MMTs, is something that in the shorter term, we are still going down here, and I can tell you that we are at weekly oversold conditions. Even though the price volatility is extremely high, we are getting down to levels here on a weekly level where this MCD is minus 30, and it's getting extremely, you get down to areas where the upside volatility, you get to a certain area where you're going to still continue to bounce up in volatility because of that, as far as the weekly goes. The weekly, we're right back here at this weekly 200 weekly moving average. And yes, the weekly S&P had a rally up to our trend line, and we've had a reversal, and the S&P is in a weekly reversal. However, why it's coming down and testing that 200 week over here in the short macro, we're getting more oversold. The thing about moving into next week's trading is that if we get a sell below it, see how this line here is called a 100-week moving average, and it's been a major resistance level, and it's been a major barrier on the S&P, and we keep going up and closing below it, and now we're falling below that more. If we get a sell-through program here, we would look to see the last time we sold below the 200 week, that was your bounce, and it got back above it, and we even closed above the body here, and we were above it here, but now we're testing that 200 week. A sell below or a gap below, we would look to see how the market would sell down to these last lows here, these two trend lines. Here's a pit stop, here's the final reversal low. Is how much selling increase would there be below the 200 week? And that's what the focus for next week will be. Short term, in a short macro, a bottom up or a resolution out of Europe or anything like that is because we are in the shorter time frame. And you can stay oversold for a number of weeks, as we have said, but there are rallies when you start getting oversold. We had one right here, the end of August. We had 2 weeks up. Yes, we did, right into resistance. This is this week. The prior week we went right up, sold right into that trend line, and now we're testing the major weekly moving average, and it would be the sell down, the percent that would go below that 200 week. And if it is a huge sell program below it, where stop market orders are taken out electronically and sellers are battling, of course we're going to take out these last lows on the S&P. Right now it's in a constructive bottom pattern, as we can clearly see, and that is the major support level. Now on the monthly level on the S&P, I've got trend lines that are very major, going clear back over into 2002 and 2003. And this upper trend line that goes right here, this is where the 2004 support kind of held in here, but we rallied on up and we kept going all the way up to the highs there, and then there was the torpedo. Now, having said that, I'm going to blow up just this piece of the chart. You can clearly see 1, 2, 3, 4, 5 months reversal. You can see here that the blue bar is referred to as a monthly convergence divergence. If it does go into such a thing such as a sell signal, which, you know, these are all lagging public standard analysis indicators, but when you do go through the monthly sell signal and or buy signal, you get great rallies. Here, peaked, and now we're coming back. And here was the last sell signal, but you'd already dropped from the high down here by the time that even got to it. Once it does, the weaker that this number gets mathematically, standard technical analysis now, is that this is going to be a major 2010 story, and here's a 2009 story. So let's pull up the 2009 bottom only, and let's take a look here at where the upper trend line would be the low on the S&P, and this was a major 2010 area where we had a 60-day breakout and we reversed. But the thing about it is that this bottom right here, this particular 2010 bottom on a monthly level, we were here last year and we kept consolidating that low on a monthly level, where so far we are selling below some key monthly moving averages. The pink line is a 50-month moving average, then there's the 100-month moving average, and then ultimately up here, the red one, the red line, is a 20-month moving average. They are being violated. And not only are they being violated, you are about to have more technical damage if the 20-month crosses over that 100-month and starts to slope down, like the 50-month is below the 100. And it already crossed over. And that means that every rally up to the neckline, and here's our trend line. There's the previous month's low of the body, and there's the high. We got right up there, and bam, we've come right back down. So the range on the S&P on the monthly level for this month of September, starting 9/1, 1140.13, and the high was right up there at the Kiska that 1229 area, and we were up there. And we rallied up there, and we've given it back, and now we had a closing of 1154. We're 14 handles from the previous month's low, or the monthly low rather. And because of the weekly moving averages descending in value, that means that any move up is going to be about as strong as overhead resistance as you're going to have. And so right now the key is that the 40-month moving average is at 1173.33. And it was on Tuesday of this last week where we hit that monthly bottom and did come back up in September. There was a day or two of September now, a couple of days of September out of the first 5 days where we had that volatility upside movement. But let's take a look at where we closed. We closed on the S&P at 1154. If you take 1173, you happen to be right now close to 20 handles, 19 handles below that 50-month declining moving average. And the 100-month moving average here, which is the kiss goodbye, it's at 1200.14. We got slightly above it, both the 100-month and the 20-month, but we rapidly got below them and started to sell down, right back below these key monthly moving averages. Now, you're not going to get any substantial great bull trend until you got a closing back above the 50, 100, and the 20. You got to close up above there. You've got to close up above the low here of the previous month. You've got to consolidate there. But no matter what, the upside 10-month moving average right here remains now at 1289, right below the 1300 level. So that's the 10-month. But right now, there's a 10-month moving average violation. All your key moving averages, the further that they fall below the 10-month, and if the 10-month starts to eventually go down in value, as it's starting to turn ever so slightly up there, that's the blue line. When they start to turn down, just like on the weekly one, here's what happens when monthly moving averages start to turn down and they cross over. Look at that. Look at that. And same thing over here. When the 10-month crosses over and goes down, look what happens in monthly movements until you finally got to a low and you cross above and you're going all the way up the hill. And here, granted that we had a great turn off the 2009 low, and the 10-month started to go the right direction, right along with the other ones. However, we're at a peak area. 60 days below that 10-month moving average is quite weak. So we always tell people why we were going to come down from here, and then we are telling people now that this monthly level here, that this trend line right here, 1100, that's going to be the one. Why do I say that? That was the major resistance level that did hold that first monthly pass there, and you got a great bounce, and you got above those key monthly moving averages right here, the previous month. But look what happened here so far. We're starting to go down below them. We're not above them. And that's why equities on intraday highs are to be sold short. And the put side of the market and the bear side ETFs are working because of it. Let it be known that this major trend line here, the first pass, if we sell through it, then you're right down in here on the S&P. And yes, you can argue, and we already told people this is that low end of that handle. That's about 1053 on the S&P, about 100 handles below here. Okay, if we break that, that would be this trend line here. Okay, we have a major monthly body bar right here, right at the top, where we had broke up above here now in that ascending 2010 low, monthly ascending pattern to the top here. Now we're sitting on it now. We're sitting on it. And that, if this market's going to hold the low, then if the S&P consolidates on a daily level above these levels and a weekly level, and we'll start with one day at a time, starting Monday. Okay? And the thing about it is where does this selling exasperate itself down there? And it does that because the further that we keep falling below these monthly moving averages, that means that the broader S&P 500 stocks are extremely weak. That's the analysis on the monthly S&P with a short macro at a 200 week with an oversold condition. However, just as exuberance can stay overbought for a period of time, the pessimistic part of things can stay down. And let us not forget that the S&P had a 31.7 handle, and it fell below that 1173, because it did, and it failed it miserably. So we just need to know right now that the 200 week moving average is 1149.037, which is slightly below the market. When we come down on it, we're going to see if we start a sell through like this wick over here, and that if the monthly body turned in price is weak, meaning that it's filled in down here like turns into something like this, is that if we close below it and if the S&P becomes new resistance at the 200 week, then that means that the S&P at that point, the probability of taking out these lows with the sell below the 200 week, even though we're short-term oversold, would exasperate it to one of these support lines, and we would be looking for a knife hook reversal. That's the analysis on the weekly and the monthly S&P 500.